Welcome back to another Explainer. Today, we're putting on our expert investment analyst hats to dissect a genuinely fascinating case study, ICU Medical. Now, this is a turnaround darling that's been turning a lot of heads lately, pulling in a massive 61% return over the last 52 weeks. But as any seasoned investor knows, price momentum doesn't always equal fundamental value, right? So we're going to put ICU Medical's skyrocketing valuation to the ultimate test and uncover the real numbers together. Let's dive right in.
Okay, here's our game plan for today. We'll start with a quick company snapshot, then weigh the bull versus bear narratives. After that, we're going to run the stock through the legendary valuation lenses of Benjamin Graham, Peter Lynch, and Warren Buffett. And finally, we'll synthesize all that data for our final verdict.
All right, Part 1, ICUI Company Snapshot. We are looking at a pure-play infusion giant.
To really grasp the numbers, we first need to understand the business itself. ICU Medical, trading under the ticker ICUI, is a roughly $4.6 billion industry titan based out of California. Over the last decade, they've completely transformed into this pure-play infusion giant, largely by gobbling up major competitors, like Hispano Infusion Systems back in 2017 and Smiths Medical in 2022. Now, breaking down their revenue, it's pretty clear-cut. Exactly half comes from consumables. Infusion systems make up another 30%, and Vital Care brings in the remaining 20%. They're driving the vast majority of their sales right here domestically, supported by a massive 13,000-person workforce that provides the absolute essential products running the IV continuum of care in hospitals worldwide.
So as I mentioned at the top, this stock has been on an absolute tear. Climbing from a low of $107, it's been trading up in the $166 to $185 range. That is a nearly 62% return over the last year. It's trading well above both its 50-day and 200-day moving averages. And honestly, what's wild about this run is that it's doing it with surprisingly low volatility. Its beta is just 0.75, which means it's actually 25% less volatile than the broader market.
Moving on to Part 2, the bulls versus the bears. This is where momentum meets reality.
What's really fascinating here is the stark divide between their operational momentum and the underlying financial reality. Wall Street is completely split on this one, and the data tells two entirely different stories depending on where you look. Let's start with the bull case, which is heavily fueled by the recent Q2 earnings report. The bulls are proudly pointing to a massive 24% beat on adjusted earnings per share. They generated 6% organic revenue growth, driven by record sales in infusion systems and a really solid $62 million in free cash flow. That cash allowed them to pay down $50 million in debt and drop their net leverage to 2.3 times. Plus, there's massive professional validation here, you know? Institutions actually own roughly 104% of outstanding shares. The smart money is clearly going all in on this operational turnaround.
But here's where the cracks start to show. Notice the massive, glaring gap between their adjusted earnings per share of $2.37 and their actual GAAP earnings per share of just 76 cents. Why such a huge difference? Well, because in Q2 alone, the company booked $21 million in restructuring, integration, and strategic transaction expenses, and that includes $10 million in non-cash asset write-offs. That definitely keeps a very harsh spotlight on the true quality of their reported earnings.
So, the bears hit back and they hit back hard. First off, the trailing price-to-earnings multiple is absurdly elevated. We're talking a range of 90 to 151 times earnings. On top of that, their return on invested capital is the dismal 2.27% to 4.56%. That is well below their 7.66% cost of capital, meaning they are currently destroying shareholder value, not creating it. Add in an estimated $30 to $40 million annual headwind from tariffs, 9 distinct guru-focused warning signs, and a pretty troubling streak of over $880,000 in insider selling over the last 6 months with literally zero insider buying.
So we're looking at a classic paradox. We have genuinely improving operations on one hand, but extreme, almost nosebleed pricing on the other. Can this strong market momentum actually survive an unforgiving valuation gauntlet? Let's force ICU Medical to run through the frameworks of the greatest value investing minds in history and see if it holds up.
Part 3, the Graham lens, the defensive investor's test.
Okay, so Benjamin Graham's framework demands absolute financial stability and a strict margin of safety. Looking at his checklist, the crucial takeaway is that while ICU Medical passes Graham's debt and liquidity tests with flying colors, boasting a super healthy current ratio of 2.43 and a debt-to-equity ratio of just 0.60, it catastrophically fails his valuation rules. Graham demands a PE ratio under 15. ICU is sitting at 90 to 151. It also completely fails his price-to-book limit and his earnings yield requirement, which currently sits at a measly 1%.
But the fatal blow in this framework? The Graham number. Using Graham's classic intrinsic value formula, which factors in earnings and book value per share, ICU Medical calculates out to a mere $11.95 per share. With the stock trading around $180, that means the market is pricing this company at 14 to 16 times Graham's conservative intrinsic value. For a true Graham disciple, this is an immediate, unquestionable rejection.
Part 4. The Lynch Lens. Growth at a reasonable price. Now, Peter Lynch is famously a growth at a reasonable price investor. He'd likely categorize this as a classic turnaround play. But remember, his rules are strict. While he'd definitely understand the straightforward infusion business and love that they generated $62 million in positive free cash flow in Q2, his framework completely rejects the valuation. Lynch's golden rule is a PEG ratio, that's price to earnings divided by growth, of 1.0 or less. ICU Medical's PEG ratio is sitting between 3.6 and 5.4. This means investors are paying an insane premium for an earnings growth rate of under 6%. When we run the numbers through the Lynch fair value formula, the estimate sits between just $21.40 and $43.94. Basically, the current stock price would need to plummet by up to 88% just to be considered fairly priced for the growth it's actually delivering. Ouch.
As Peter Lynch famously stated, the PE ratio of any company that's fairly priced will equal its growth rate, right? If your PE is 89, your growth rate better be near 89%. At 89 times earnings with only 5.8% growth, this stock is definitively not fairly priced in the Lynch universe.
Part 5. The Buffett Lens. We're talking quality, moat, and returns. Warren Buffett cares deeply about wide economic moats, consistent owner earnings, and high returns. But his checklist brings yet another hard pass. While the company's gross margins are solid at 41%, which shows they have some pricing power on their core products, the bottom line returns are just abysmal. An ROE of 1.41% and an ROIC hovering around 2 to 4%? Those are absolute deal breakers for a Buffett-style investment. Remember, Buffett demands a minimum of 15% return on invested capital.
And what about that all-important economic moat? Well, it's a bit of a mixed bag. Hospitals face incredibly high switching costs. Once they install a specific brand of infusion pumps and the associated software, they rarely want to change them out. It's just too much of a headache. But despite that built-in advantage, Morningstar actually rates ICU Medical as having no moat. Why? Because their severe struggles in integrating the massive Smiths Medical acquisition have resulted in huge restructuring costs, and that is ultimately destroying shareholder value.
Buffett always says, price is what you pay, value is what you get. At roughly $180 a share, you're paying a massive, massive premium for a turnaround story that is currently earning less than its own cost of capital. Warren Buffett would take one look at those ROIC numbers and just walk away.
Finally, Part 6, Synthesis and Final Verdict.
We've officially run the gauntlet. We've looked at the operational wins, the accounting red flags, and put the financials through the ringer. And looking at these disparate valuation models, the disconnect is massive. All three legendary frameworks unequivocally reject the stock. Even when we ran a base case discounted cash flow model in the background, forecasting out their free cash flows and applying a standard WAC, or when we looked at comparable EV to EBITDA multiples, the fair value still only topped out around the $120 mark, which is super similar to the GF value estimate. By almost any fundamental valuation metric, the stock is currently 38 to 40% overvalued.
So, what's our final recommendation? Well, for value investors, this is an easy avoid. There is absolutely no margin of safety here. If you want to follow Graham, you'd need this thing at $12. For Lynch, under $44. For momentum and turnaround investors, look, the operational improvements we saw in Q2 are very real, but we suggest keeping this strictly on your watch list. You're going to want to look out for key catalysts, particularly the FDA approval submission for their Metafusion 5000 syringe pump, which is expected later this year. But whatever you do not chase this rally. If you're a standard DCF or turnaround investor, wait for a significant pullback toward that $120 intrinsic value mark, or wait for definitive proof of sustained margin expansion before deploying your capital.
I want to leave you with this final provocative thought to chew on. ICU Medical is definitely doing the hard work to turn the ship around, but the market has already priced it as if the turnaround is flawless. So, can ICU Medical fix its margins and finish integrating its massive acquisitions before gravity finally catches up with its 151 times PE ratio? Keep a very close eye on those next earnings reports, because the clock is ticking on that valuation.
Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll see you next time.